is not empty. It contains everything.
Why stop hunting works? One word: liquidity. Many are familiar with the story David and Goliath. In a nutshell, this is where Goliath gets his ass handed to him. Forex trading is one game where size matters. I will attempt to illustrate on the charts at the end of this video how we as retail traders can take full advantage of our small size relative to the market maker or institutional trader. For now, take into consideration that it would cost about 10,000 lots to move the market by just 1 pip. The big players or the market makers' ability to dominate the market is genuinely overwhelming. When retail traders like ourselves place trades, it's something we need not think about too much. We hardly need to think about when and where we can take our trades, as it's always possible to take our trades whenever and wherever we like. The market is liquid for us. It means that there is an endless supply of buyers or sellers at any given moment who are willing and able to take the opposite side of our relatively small trades. So this level of liquidity does not exist for the big players. The same advantage is not accessible to the market makers who transact with significant sums of money regularly. Take the following scenario. A huge company in Europe wants to acquire a big multinational company from the United States for $5 billion. Because of this massive order size, this transaction cannot take place merely by going to the nearest currency exchange office, or in one go for that matter. They would need to split this transaction into smaller, workable chunks, and over several days, weeks, or even months. And additionally, the European company would have to get this transaction done via approaching a big investment bank or a brokerage firm. The amount of red tape involved in a transaction this size is ridiculous. Let's say that the deal is on the table and it involves our favorite currency pair, the euro versus the dollar. In this case, the European company ultimately needs dollars. They will need to sell their euros in exchange for dollars. This is because the American company ultimately wants to receive their payment in their preferred currency and domicile, which is dollars, United States dollars. The European buyers in this case will find it near impossible to execute an order of this magnitude at the preferred price and on a spot basis. The problem is that they would need to find a counterparty who is willing and able to buy euros at that precise moment. Now, this obstacle for them is an opportunity for us, the retail trader. The bigger players who have the money to move the market in whichever direction they want, they are constantly faced with this liquidity issue. They have no choice but to manipulate the market, or they will be unable to execute their large orders. They'll be out of business. The manipulation that they need in itself, the manipulation is a thing of beauty. Looking at this on a chart, an MT4 chart or a trading view chart, you can see it's a beautiful looking maneuver. However, it is quite cruel. The bankers in charge of this merger and acquisition, they know that they ultimately need to sell euros in exchange for dollars. They know that their goal is to sell. However, they would need to do this transaction and make a ton of money in commissions at the same time. And to achieve this goal, they must get an excellent exchange rate. So the manipulation has to begin. Market makers start pushing the value of the euro up, buying at strategic levels and pertinent times of the day, sometimes using scheduled economic news events to help achieve the goals. I call this a news-induced market manipulation. Beautiful trends and familiar patterns start luring in the retail trader, enticing them to buy. This plethora of buying drives price closer and closer to a more favorable level, a better exchange rate where the market maker wants to do some business. He wants to transact at this level, so he moves prices up. Now that there is an inflow of buyers, the liquidity has also taken an upturn. This means that there are now more buyers willing to take the opposite side of the market maker's inevitable selling frenzy. The fun does not end here though. When prices have been driven up to the level of importance, some call them supply levels or resistance levels, doesn't matter. Traders of all sorts become trapped. This is what matters. The panic sets in for level traders, breakout traders, retracement traders. I'll go in depth in a later video about the various types of traders involved here. But for now, as we build this strategy together, just be aware that the transaction that the market maker needs to make cannot take place without the liquidity that the retail trader, you and I, provide. So stop hunts occur regularly in the market. It is part of the market cycle. It's always been that way, and it most probably always will. I use a strategy and a technique or a process that takes full advantage of this need that the market maker has. Now, off to the chart. To illustrate the importance of liquidity on a price chart, let's take a closer look at our example again. We have our European company who shows an interest in the purchase of the American company. Let's give the company a name this time and call them Taylor Guitars. So our European friends wants total control over Taylor Guitars. Taylor is willing to accept $5 billion in exchange for total control. You must bear in mind that ultimately Taylor will accept US dollars only as payment, which means that the Europeans will have to exchange their euros for dollars at some point. So the hunt for a favorable exchange rate begins. The Europeans approaches the investment bankers in charge of mergers and acquisitions. They have some meetings with the risk department and the foreign exchange hedge team who are involved with the setting of the forward exchange rate. And of course the meeting involved the FX traders. So this team of specialist bankers see a potential for massive profits, and it all starts here as the traders approaches the euro dollar charts. Prices are quoted at 1.4770. At the current price of 1.4770, we will calculate the value of the euro versus the dollar. In other words, how much euro will it cost to purchase just $1? The reason we need to know this is because we can further calculate the total euros it would cost to purchase Taylor Guitars for $5 billion. The calculation is simple. Take 1, divide that by 1.4770, this is equal to 0.68 euros. Further, take 0.68 euro, multiply that by the purchase price of $5 billion. This now shows us that it would cost in total 3.4 billion euros to purchase Taylor Guitars. But that is if we sell right here at current prices. What we know so far is that if our European friends sells euros right here, it would cost them about 3.4 billion euros to purchase Taylor Guitars. If they are able to move prices up into a more favorable exchange rate area though, then it would cost them significantly less to purchase Taylor Guitars. But that will become more clear later on in the video. They would need to manipulate this area. If they need to push prices further up, there would need to be a significant amount of liquidity in this area. In a trend where prices are going up, it's making higher highs and higher lows, the retail trader are all placing buy orders. Also, we are at a significant area of support, more buy orders. So what would need to happen in this area is a manipulation. Our European friends would need to show that prices are breaking out and going short. We need some selling in this area in order for the Europeans to buy. So what they do, I need to show you this on the 4-hourly chart. This is the same trend line from the daily, and this is the 4-hourly chart now. So if we move slightly forward, our bars are going down, and then the breakout. We have a significant breakout. If we have a look at the daily chart, we have broken out of the trend line, and also we have broken out on the area of importance, this very good looking support area here. So the retail traders are now selling, and the more selling that there is in this area, the more liquidity there is in this area. There are now sufficient sell orders for our European friends to buy. Now they are able to place a significant order in this area to move prices up into the area where the exchange rate for them is more favorable. Remember, they inevitably want to sell their euros, but not at this point though. The next day, prices are pushed up even further, and it goes up and up. More manipulation, more accumulation. Buyers and sellers are now both trapped in this area. Remember, the inevitable move of the Europeans is to sell. Boom. Now we have a breakout going long. What we have in this area now is retail traders placing more and more buy orders, creating enough liquidity for the inevitable selling frenzy. And then prices are at 1.5124. Now we do the same inversion calculation that we've done before. 1 divide that by 1.5124, that's equal to 0.66 euros. 0.66 euros times the 5 billion. If our European buddies sell here, it would cost them $3.3 billion to purchase Taylor guitars. That is a whopping 100 million euro saving. And it does not end there though. The party has just begun. Here we go, guys. This is the start of a 1,000 pip move down plus the 100 billion euro in profit that they've just made. And this is just a simple day at the office. Boom, profit done. In the next lesson, you will learn the exact entries, stops, and profit targets for this strategy.